Ladies and gentlemen, good morning. Welcome to the Annual Results 2015 conference call and live webcast. I am Maria, the Chorus Call operator. The conference must not be recorded for publication or broadcast. At this time, it's my pleasure to hand over to Mr. Olsen, CEO of LafargeHolcim. You will now be joined into the conference room. Thank you.
So good morning, everyone, and good morning to everyone here in Zurich, and welcome to everyone who's joining us on the call today. Thank you very much for joining us. Today it gives me great pleasure to introduce Ron Wirahadi-Raksa, our new CFO, who a number of you have already had the opportunity to meet and talk to. He's going to walk you through the detailed results today. 2015 was certainly a year of change and transformation for the group, with the merger being completed on July 10th. Now, after 8 months, our integration is largely behind us, and I'm confident we are well positioned to drive solid growth in profitability in 2016. I'm going to cover 4 topics this morning. I will start by talking about 2015 and giving you an update on the merger and integration activities. Then I will talk briefly on the results themselves before commenting on the portfolio changes announced today and the 2016 outlook. After that, I will hand over to Ron, who will give you more detail on the fourth quarter and full year numbers. Let me start with the merger and our 2015 commitments. I am pleased that we exceeded our targets and our commitments we made. We delivered 130 million of synergies compared to our target of 100 million that we committed to. We have met our CapEx target, reducing our spending by 200 million in the second half of the year compared to the original plan through a disciplined approach to our investments. And our focus on free cash flow delivered results and drove a 1 billion Swiss franc net debt reduction in the fourth quarter. Beyond our commitments, I see additional opportunities emerging on costs and on pricing. I see it on the costs we can save in some challenging markets, and where the merger allows us to go further and deeper. I see it in synergies, where we can go faster and where we have action plans to go well beyond our synergy targets. And I see it in pricing, which today is a key area of focus for us. I believe that the most challenging dimensions of the merger are now behind us. Our operating model and organization are fully in place. We have finished the integration of our head office functions, with downsizing well underway. With the operation we announced this morning in Morocco, we will have completed almost all the local mergers that were necessary to fully integrate our network. Indonesia was completed in February, and Malaysia during the fourth quarter. 2015 was a year of change and transformation, but we now have the momentum to streamline, transform, and execute our plan. Our commercial transformation is well underway with a tight focus on pricing. Rigorous CapEx discipline is being applied throughout the organization, and thanks to the merger, we've been able to go faster and beyond what both companies could have done on a standalone basis in the more difficult markets. And finally, we've committed to deliver 3.5 billion in divestments in 2016. We've completed our first portfolio review, and as you have seen in our press release today, 1/3 of the program of 3.5 billion in divestments has been secured, with the rest of the program firmly in hand. Now turning to the fourth quarter and full year results. It's clear that they have been affected by external factors such as adverse exchange rates and a challenging environment in selected markets, notably in the second half of the year. This is disconnected from the merger, and I don't want you to mix the potential of our merger with the impact of the difficult trading environment in a few selected markets. Looking at our performance, I see 3 main points I'd like to highlight for you. First, that we continue to see positive demand trends overall. This is supported by positive developments in markets, including the U.S., Mexico, Argentina, the Philippines, Australia, and the UK. And we expect this to continue for the year ahead, with only a handful of markets expecting declines. The so-called broad-based emerging market crisis we are just not seeing in the underlying activities in our markets. Secondly, we have been impacted in 2015 by a limited number of challenging markets. The principal markets impacting us include Brazil, China, Switzerland, France, Indonesia, Iraq, and Azerbaijan, with notably challenging pricing conditions which put pressure on our overall performance. The issues in these markets are unique to each market and driven by external factors and do not represent a broad-based trend. That being said, and this is my third takeaway, we have reacted forcefully in these markets, and the results of our actions will contribute to our results in the coming quarters. We are taking decisive actions to address our cost base in the most challenging countries. We have restructuring activities underway right now in China, France, Italy, Belgium, Russia, and Brazil. For instance, in Brazil, we have reduced our SG&A by 1/3 in the country and our fixed costs by 25%. 3 cement plants have been mothballed, 17 ready-mix plants closed or divested, which is 40% of the total, and only 1 quarry has been closed. In Russia, we've closed 1 site and will leverage our 2 other Russian sites in the future. We also have restructured the head office. Beyond these actions and costs, I have at the top of our agenda a rigorous focus on pricing, which will show results in the quarters to come. I'm confident that these actions will improve the performance of these markets in 2016. Now I'd like to cover the portfolio optimization activities that I mentioned earlier. As part of our divestment program, today we have announced 2 divestments in Saudi Arabia and South Korea. We've also announced an exciting development in Morocco, and I want to spend a moment on that. In Morocco, we are enlarging our partnership with SNI to include all the assets we have in Morocco. In doing this, we create a unique platform and expect to generate 45 million Swiss francs of synergies on a run rate basis, notably through optimizing our logistics and cross-selling. This is ahead of our initial expectations. This operation will also have an immediate positive impact of 600 million on our net consolidated debt. As I mentioned earlier, and based on our portfolio review exercise, we have also launched actions to further optimize our network of assets, notably in China, Russia, and Brazil. This, by the way, lies at the heart of the impairment charge that we have taken this quarter. Ron will take you through the accounting consequences in more detail in a minute. Now turning to 2016. In short, we see solid progress towards our 2018 targets we announced in December and that we reconfirm today. In terms of outlook for 2016, we see demand in our markets growing 2 to 4%. We believe emerging markets will continue to grow overall. Our actions on pricing will deliver results over the coming months, and the delivery of synergies will accelerate with notably more than 450 million incremental EBITDA synergies expected this year. And our additional cost initiatives that we have taken in our more challenging markets and our focus on operational excellence will contribute to our results beyond the synergies. I am confident that the combined effect of all these actions and the strengthening price environment will drive solid progress towards our 2018 objectives. I'd like to now hand over to Ron to walk you through the regional performance and give a little more granularity on some of the financial details.
Thank you, Eric. Hello, everyone. It's a great pleasure to be here this morning and present to you the fourth quarter results and the full year results of LafargeHolcim for 2015. I'd like to start by looking at some of the key figures. There's some numbers here that I'd like to draw your attention to because they do tell the story of LafargeHolcim in 2015. The first is the full year cement volumes. In like-for-like terms, volume was up 4.8% for the quarter and by 0.2% for the full year. Adjusted operating EBITDA on a like-for-like basis was 8.4% for the quarter, down, and the figure was down 4.6% on the year. That was really about pricing in a limited number of markets, and I will expand on this when I take you through the Q4 EBITDA bridge later. We announced our 2018 target with our third quarter results in November last year. At that time, we said that free cash flow will be the true measure and reflection of business success. And therefore, I'm pleased to tell you that in Q4, the free cash flow was 813 million after one-off items and 733 million for the year. Two more things I'd like to mention to demonstrate our 2015 progress. First, we are reducing net debt faster than we targeted. It's now 17.3 billion. And the second is CAPEX. We are doing what we said we do in terms of reining it in. The second half CAPEX was lower than 1.4 billion, which in itself was 200 million lower than our earlier target of 1.6 billion. On to the Q4 adjusted EBITDA by region. I'm going to take you on a tour around the world with some comments on the regions because this is how we report. However, as Eric already said, our story is very much a market-by-market story because every country has specific challenges and opportunities. First, Asia Pacific. A number of markets performed well here, and that's typical of what we've seen across emerging markets. We experienced strong growth in countries such as the Philippines, Vietnam, and Australia. The Philippines achieved a stellar year with improvement in both cement pricing and volume thanks to the robust development in private and public construction. In Vietnam, higher demand translated into top-line growth. In Malaysia, we benefited from the projects such as Petronas Refinery and Petrochemicals Integrated Development, along with other important projects in the region. China had a negative impact on our results due to the cooling off of the overall economy and the overcapacity. In fact, it reduced the region's adjusted full-year EBITDA by more than 6%. However, we are taking robust action here to change things. Synergies from integration with LSOC will improve the quality of our operations and competitiveness to counter the negative market conditions. Volumes in India in Q4 were up, but capacity increases outpaced demand, and this put pressure on prices. Lastly, delays in infrastructure projects and pricing pressure affected the results in Indonesia. In net sales terms, the Q4 like-for-like number for the region rose by 2.6% year-on-year. On to Europe. The region experienced a moderate recovery amid more challenging global conditions. Overall, Q4 cement volumes were supported by a comparatively mild winter, but underlying dynamics remained slow. The UK market was fueled by the positive macroeconomic environment and a strong construction sector. Romania benefited from higher volumes across all segments thanks to the improved market conditions, which paved the way for opportunistic projects. On the other side, the Swiss market was negatively impacted by the strong Swiss franc, making imports significantly more competitive. France experienced a declining housing market and sluggish government spending despite lower energy prices. In Russia, the combination of the steep oil price decline and economic sanctions resulted in a sharp fall in cement volumes. Overall here, the like-for-like sales fell 1.2% in Q4 versus 2014. In Latin America, the impact of Brazil on what was broadly a good performance was significant. We have instigated actions here to address the situation, but the impact was such that without Brazil, the region's like-for-like adjusted EBITDA would have been up 17% for the year. Argentina, Colombia, and also Mexico performed very well, where we saw good price and volume growth. In Mexico, the economic recovery was fueled by the national infrastructure plan, residential and energy sectors growth, and this translated into price and volume increases. Colombia benefited from its continued momentum from 2014, driven by strong market growth and significant public infrastructure and housing projects. And finally, in Ecuador, infrastructure development slowed down considerably as the country faced a wide budget deficit, which was triggered by the low oil price environment. Like-for-like sales in Latin America rose 1.3% in Q4 compared to 2014. In Middle East Africa, many markets posted solid numbers, and sales grew year-on-year on a like-for-like basis. In Algeria, both prices and volumes increased across all segments as demand grew in a context of no capacity additions. In Egypt, we benefited from a solid cement demand boosted by ongoing public infrastructure projects and macroeconomic tailwinds. However, overcapacity in the market and competitive pricing had a negative impact on overall performance. Cement volume in Kenya were backed by construction activity, which was supported by government efforts to modernize transport infrastructure. Broadly speaking, the oil-dependent economies tended weaker, such as Nigeria, where depressed energy prices affected investments. Sales for the quarter rose 3.7% on a like-for-like basis against 2014. Let me finish the regional overview on a high note. The economic recovery in the U.S. and the robust performance in East Canada were a significant contributor to our positive global like-for-like sales in 2015. Operating performance was driven mainly by a double-digit increase in operating EBITDA in the United States, as well as an overachievement on synergy realization. The solid volume growth in the United States was mostly driven by the dynamic residential market. In East Canada, construction projects and increased exports to the U.S. and resulted in a good market mix and pricing gains. Low oil prices affected areas including the western provinces of Canada. Overall volumes there were down 9%. However, we are working on cost improvements to mitigate the effects on results going forward. Net sales in North America were positive, with a 3.1% like-for-like rise in Q4 versus a year ago. Now, I'd like to explain the evolution of Q4 adjusted operating EBITDA. Starting on the left, volume was a positive. To unpick the price impact on EBITDA, 150 million of the negative price impact came from 5 countries: China, Egypt, India, Switzerland, and Indonesia. That's 5 out of 90 countries. So it's very clear that severe negative pricing was a rather concentrated issue and mainly the results of existing excess capacity or capacity increasing, outpacing demand growth. For example, China suffered from a cooling economy with overcapacity. Egypt has significant overcapacity in the market, which resulted in a very competitive pricing environment despite strong volume growth. In India, demand increased by 3 million tons, but capacity increased by 23 million, driving pricing down. Switzerland had a unique issue with a strong Swiss franc, as I said earlier, making imports significantly more competitive. The impact of costs and others, CO2 and negative forex impact, offset the positive synergies number. On cost, as you see, we had a negative 127 million cost variance. The main drivers of this variance were the correction for a one-off event, increased fixed overhead absorptions due to lower inventory levels in Q4, or the high level of inflation in Argentina. These factors more than offset the positive contribution from lower energy costs. The synergies are being uncovered as we take actions to integrate the 2 companies. The costs you see against merger and restructuring are an indication that we are well advanced. For the full year bridge of adjusted operating EBITDA, you can see some different influences. The price effect of those 5 countries was such that without them, the price effect actually would have substantially offset the cost effect. On cost, the impact of inflation in Argentina added 70 million to that line. The other elements are the full year forex effect, the positive synergies which we discussed as being 30 million ahead of plan, and the full 2015 cost associated with merger and restructuring. Now let me spend a moment on the synergies. We are optimizing our network in markets where there is overlap. We've made good advancements on procurement, renegotiating the top 2,000 contracts, for example. And SG&A costs are being brought down towards the target of less than 7% of sales. In terms of restructuring, we are taking actions across our markets. In Brazil, for example, we have done a lot of rationalization of overlap, and in the U.S., we have worked on pension costs. Aggregated, those actions mean we are 30 million ahead of plan. The effects of the synergy ramp-up will keep going into 2016. Moving on to asset impairments and provisions review. A merger like ours means we have to take stock, understand all of our assets, what we wanted to keep, and the actual value of that to the business. We were systematic and rigorous about it. The figure of just under 3 billion for the year is comprised of 962 million for goodwill, 1.6 billion for property, plant and equipment, and other income and financial expenses made up the rest. I want to reiterate, this is a non-cash one-off measure, and that we have accounted for these things in a robust way. Moving now to the reconciliation of our pro forma adjusted financials back to the reported financials for 2015. The group had a pro forma adjusted operating EBITDA of approximately 5.75 billion, which represents 12 months operations of the group. This excludes the net impact of one-offs, restructuring, merger-related costs, and merger accounting adjustments charged in 2015. At a net income basis, our pro forma adjusted net income is approximately 0.8 billion. And like EBITDA, it represents 12 months pro forma operations of the group. This also excludes the net impact of one-offs, restructuring, merger-related costs, and merger accounting adjustments. Moving on to talk about our net financial debt and explaining the bridge of that for the fourth quarter. We started at September 31 at just over 18.3 billion. The cash flow was clearly the biggest reduction metric in the last 3 months of 2015. As said, we kept a tight rein on capex below the 1.4 billion second half target. Divestments and net financial disposals, and in non-cash terms, the forex effect, all helped to deliver a figure at the end of the quarter of just under 17.3 billion. That is 200 million under the year-end target that we communicated. Now let me update you on our financing strategy. We are focused on a solid investment grade rating, and that remains our key financing consideration. Another priority is to extend the maturity profile. We have about 6 billion of debt that matures this year, and 4.3 years is the maturity profile, and that's well under our ambition of more than 5 years maturity. The group has targeted 3.5 billion of divestments, and the proceeds of that will go towards reducing gross debt. I'd like to talk about our performance management system initiative. This is intended to deliver better visibility and alignment of performance across the merged group. It makes it easier for everyone to see their goals and to achieve them. But I also want to talk about the new value drivers. They are completely consistent with the metrics we use to measure business performance. A focus on pricing and cost, free cash flow, lean asset use, and the efficient use of capital. Moving to the 2016 outlook for the cement market. You can see at a glance where we see growth and how it filters down to our view of 2 to 4% market global growth. So on the whole, we are marginally more optimistic about volume growth in 2016 compared with 2015. And we are focused on achieving this growth with disciplined pricing such that most of the growth will fall to the bottom line in the form also of free cash flow growth. This is part of the commercial transformation journey that we have embarked on. By region, Asia Pacific looks positive because we see conditions improving in India while we take action in light of the economic circumstances in China. Europe we expect to improve broadly across all markets, but the outlook for Russia and Azerbaijan will remain weak. In Latam, again, the region should broadly perform well, but Brazil will continue to weigh on results, even as we work on initiatives to improve our performance there. Mexico is forecast to perform well, with positive outlooks on price and volume. The Middle East and Africa will still be impacted by oil price weakness, but offsetting this, we see resilient markets across the region. In Algeria, for example, we have responded to robust demand by bringing on a new plant in Biskra to capitalize on the upturn. North American volumes are expected to remain robust as they were in 2015, and again in Eastern Canada and the US. Lastly, I'd like to look at the cement market in some selected countries. This is a selection of those major markets. They are a good proxy for the overall cement market, but in China and the US, the forecasts are for those markets in which we as LafargeHolcim operate. You can see there are some negative outliers. There's Brazil and Russia and China, to name a few. Those are markets in which we are taking actions to improve operational performance. The majority, though, are positives, more black ink than red, which netted out means that we do see demand growth in 2016. Thank you, and I'm now going to hand it back to Eric.
Thanks a lot, Ron. Before we conclude and we go to questions, I'd like to take a step back and another look at LafargeHolcim. Longer term, you can see on this map that our portfolio is uniquely positioned to capture the growth of the major trend that underpins the demand for our solutions, which is global urbanization. According to the UN, from where we are today, the population in cities will double by 2050. Sophisticated building solutions will be required to create a sustainable urban environment for the future. We will have a critical role to play in building this sustainable urban environment. This is an outstanding opportunity for us to differentiate, and following the merger, we have everything we need to be successful. We have a portfolio of activities ideally positioned to serve this global urbanization trend. We have best-in-class R&D capabilities. We have industry-leading sustainability standards in our operations. We've got products and solutions that can raise the standard of sustainable construction for our customers, and we have the best talent in the industry. Our strategic pillars are very clear. A market-driven strategy based on maximizing the value for our products through differentiation and customer focus. Cost excellence, which is the entry ticket in our industry. Asset optimization, which means leveraging our existing assets and growing with less capital going forward. And fourth, sustainability, a differentiating factor which is embedded in the way we operate and in the products and building solutions that we offer. With our strategic plan in place, we are confident we are creating a company that will deliver value to all stakeholders and represents an attractive investment proposition. I want to bring this presentation to a close by reminding you of our medium-term targets for 2018 that we communicated to you on December 1st in London. As you know, our primary focus is to maximize free cash flow generation. Our key financial measure for success will be our cumulative free cash flow generation over the period 2016 to 2018, which will exceed 10 billion Swiss francs, notably supported by synergies and our commercial programs. The most difficult part of our merger is now largely behind us, and we will see in 2016 the benefit of the actions we have undertaken in the past months in terms of cost, prices, and cash. Our key objective is to combine superior cash flow generation and strict capital allocation discipline, which means securing an solid investment grade rating. Secondly, strictly controlling our CapEx while actively managing our portfolio. And then third, commensurate to our solid investment grade rating, returning excess cash to shareholders. On the basis of the outlook that we have shared today, we are confident that 2016 will show solid progress towards our 2018 objectives, which we reconfirm. Thank you very much for your attention. I am now happy to take your questions. Could you please be considerate and limit them to two so we have plenty of opportunities such that everyone can take their questions? Thank you.
From Exane BNP Paribas. So two questions. Firstly, we've seen a negative impact of low commodity prices in a few emerging countries last year. And your volume forecast suggests that this could still be a headwind in a few countries this year. Do you see a risk for 2017 if oil prices remain low in countries like Algeria, Nigeria, Colombia, or Mexico, where you expect growth in 2016? And then my second question is on market share. We've seen the market share of Holcim and Lafarge being impacted in a few emerging markets over the past few years due to new entrants and local producers increasing capacity quickly. Could your portfolio review and disposal programs improve your global position and help reverse these trends?
Sure. Thank you for the two questions. So let me take the first one on low commodity prices first. You see a mix of different effects in our markets, and look at the big down markets that were on the slide that Ron shared earlier. You see a big negative, for instance, in China. That's not driven by low commodity prices, for instance. You see a big negative in Brazil. It's not really driven by low commodity prices. However, you do see a negative in Ecuador that was on the chart, which is more driven by that. So it's really a mix. I don't see a broad commodity trend impacting our business really in 2016 or 17. I see it more isolated market situations to understand the situations. Now, going to the countries you listed, I think you mentioned Algeria, Colombia, Mexico, and Nigeria as well. What we're seeing in the fourth quarter and the trends that we're seeing reconfirmed in our expectation for 2016, we're really not seeing the impact in those markets thus far. And so we're confident that those markets will remain robust in 2017 as well. On market share, let me be clear. My strategy is not a market share strategy. My strategy is to have a very competitive, cash-generating business wherever I operate. And you're right. We did a portfolio review, and we've carefully looked at the 90 markets where we are, and we've taken some decisions, and you're starting to see those decisions being announced even today. But those decisions aren't based on market share. Those decisions are based on what is the best and most attractive environment where we can play, and we're going to play in places that are A, attractive, and B, where we, LafargeHolcim, have a strategy and a positioning to win over the long term. It's a unique opportunity, and we've said this from the beginning with this merger. It's a unique opportunity to take all the collective assets and put them together and to rethink, okay, how do we increase and improve the average quality of our portfolio? And I think we've got a great portfolio. We've got the great, as I showed on the chart, with the demand. But one of the levers to improve the value creation is to increase the average quality of that portfolio, and that's what we're doing, and that's what you will see increasingly with the divestment program. Thanks. Yes. Oh, sorry. We'll come to you next. We'll go. Thank you.
Thank you. Remo Rosenau, Neue Helvetische Bank. We've been in India with Holcim in 2007. There the margins were around 30%. Now we're significantly lower. We constantly heard, outlooks which were constantly underachieved. Again, now we heard the fourth quarter there was volume growth, but unfortunately capacity is expanded even more than that. The capacity-demand balance goes in the wrong direction for a long period of time. So when will it finally start to get better? What is your take on the situation in India?
Right.
That is the first question. And the second one is, could you possibly remind us on how exactly your remuneration is linked to the reaching of the targets 2018? Thank you.
Certainly. Let's take India for starters. India is a great topic that I've been there, I think, 3 or 4 times over the last 3 or 4 months. So I'm very familiar with the situation, the market, the trends, and happy to. I'm very optimistic on India for a lot of reasons right now. But maybe we come back and answer the first part of the premise of your question, which was things have come down and it's been a bit disappointing the last couple of years. And you're right. You're exactly right about that. And maybe I think it's important to ask why. One of the things, as you mentioned, is there's been excess capacity. So India went through an extended period of long, high growth, going back when you said you visited the country, where we are having 5, 6, 7, even 8 or 9% annual growth. For the last 3 years, we've had relatively low growth. I think the growth in India in 2015 was 1%. Yet the capacity expansion pace was going along the lines of previous growth rates. So it has created some level of excess capacity in India today, and that is reflected in more difficult market conditions. However, if you look at the per capita consumption rates in India, there's only one place that long-term demand growth can go in India. It's up. This is not a market, a slow growth market. This is a long-term growth market. And as almost 20% of our global capacity as a company is in India, it's one of the great value creation levers and opportunities that we have over time. So why am I optimistic about 2016? One, India is one of those real winners in, the question before about commodity prices. It's a net importer in a significant way of oil. And we have an opportunity. The Indian economy is very well positioned right now, and we're saying in our notes here that we expect for the year 4 to 6% growth in the economy. That's a big economy. That's a big cement market that will continue to grow. That will be a favorable situation compared to the situation in 2015. And you see other evolutions in the Indian market, which we think also will reinforce attractiveness in the market. From our standpoint, LafargeHolcim, we're also taking actions that maybe we were a little too slow in taking, in moving to petcoke from coal to reducing our energy cost usage. And in the last 2 or 3 months, we've been aggressively moving and converting our plants to petcoke, which will improve our cost structure in 2016 as well. So we've got cost reduction plans in place. I think the overall market situation is going to be more favorably structured or set up in 2016. So I think we're going to have a favorable year of growth in 2016. Going to a totally different question, which is your question on compensation. So my long-term compensation and that of the executive committee, Ron and the other members, is very much linked to the achievement of the targets that are listed up there. So, for instance, the free cash flow generation target, and even to get the maximum amount that was listed in the report, I have to go well beyond those levels to achieve them. Those targets are our targets that we want to achieve, but we're, of course, as an organization, our plans in place is to do better than that, and my incentive is to do better than that. So I'm incented on the synergies. I'm incented on the cumulative free cash flow generation over the period 2016, 2017, 2018. I'm incented on EBITDA and on return on invested capital. Each one of those blocks that you see up there are critical triggers for my compensation and for that of the executive committee.
Is some part of the compensation also in shares which are locked?
Yes, absolutely. So for instance, and it's all in the report that was put online today, but a significant piece of the annual bonus even piece is locked up in shares that are blocked for a certain period of time. Okay. And it's all laid out in detail in the compensation report that was uploaded today.
I will read that. Thank you.
And if you have follow-up questions after, we're happy to go into more detail on it.
And in India, I mean, bottom line, you say that there is more capacity, i.e. less capacity, new capacity coming on stream than volume growth.
Right, exactly. Plus, you have more demand than you had in previous years.
Okay, thank you.
Sorry, we cut off the question over here before. Sir? Thank you.
Thank you. It's Christian Arnold, Bank von Tobel. I have 2 questions. On the one side, on property, plant, and equipment. Here, you informed that you have an impairment of 1.6 billion on PPE. Now, comparing the 9-month PP book value of 37.2 billion and the year-end book value of 36.7 billion, there's not much of a difference. Maybe could you explain what's behind that? And then on the 3.5 billion divestment program here, could you give us a rough indication how much capacity is actually behind this 3.5 billion? Thank you. Okay,
well, I'll ask Ron to comment on the first question, but before that, I'll just answer about the divestment. So just to summarize where we are on the 3.5 billion divestment. So we announced 3 countries, deals around 3 countries involving 3 countries today: South Korea, Saudi Arabia, and Morocco, and they're of a bit different nature. South Korea was a fully consolidated operation in our activity. Saudi Arabia was not, and Morocco is a unique combination to create a fantastic growth platform going forward in Morocco. And then those represent about a third of the total 3.5 billion divestment which we've secured. Now, in addition to that, what we have announced is that India, the legacy Lafarge operations in India, which is approximately 10 million tons of capacity, in addition, is part of that program. We're not, of course, announcing what the amount is. We're in a divestment process involving that right now. And there's a number of other countries and activities that we're working on, but we've chosen for practical reasons to not announce that in those countries. We're working on them, and as soon as we have a deal, we'll announce it. So it's difficult for me to say, because there's a set of countries that we haven't announced around, that to come and say, well, the total capacity involved is a certain amount. What I can say is I'm driven, and I will only accept good, attractive deals for LafargeHolcim. We have plenty of opportunities, and I'm very much focused on getting good value and attractive value for those assets in the 3.5 billion divestments. So now maybe, Ron, I could ask you to respond to the first question.
Yeah, so you're referring to the 1.6 billion of asset impairment. So we're also still so I understand the question, why is it not 1.6 billion lower, right, overall?
You're also investing, of course, but...
Correct.
Yeah,
we're also investing, and as we said, we are still in execution of a number of projects of new plants coming on stream. We have the Barroso plant in Brazil. We have a few other plants coming on stream. So I believe that the net of that, makes a difference less than you would think. Keith, do you want anything to add to that?
I think also, obviously, the opening was 21 million, added another 20 million for the merger of Lafarge. And then with the normal depreciation, the impairment, as well as 2 billion of investments, you get to the 36 million. And I think the numbers actually stack up quite well.
Okay. So why don't, Michelle, so we don't overly take only questions from people who are here with us in Zurich, we could take maybe 2 questions for people on the webcast. That's how we can come back to other questions here if you have questions, don't worry.
Our first question from the phone comes from Mr. Arnaud Lehmann, Bank of America Merrill Lynch. Please go ahead.
Thank you very much. Good morning, gentlemen. I have 2 questions. My first question is regarding the restructuring you're planning to do, I believe, in some of your difficult markets. You mentioned Brazil, France, China, etc. Could you confirm that this is incremental relative to the 450 million of merger synergies that you've been discussing? And if it's incremental, do you have a number for how much savings you expect from this restructuring initiative? And do you believe they're going to be sufficient to fully offset the incremental decline in volumes, likely, I guess, as you mentioned, in Brazil and India? That's my first question. My second question is possibly for Ron. You have a very complex portfolio today. We've seen the currencies moving around. The Swiss francs is getting a little bit weaker relative to the euro. That's good news. On the other hand, emerging market currencies, some of them have been a bit all over the place, the Brazilian real, etc. So would you be in a position today to give us the impact of currencies on your operating EBITDA based on spot levels or year-to-date levels? Thank you.
Okay, so why don't I'll start with the question on restructuring, and then Ron, you can go to the FX question. So we have taken a number of restructuring activities, and I would say part of them are linked to the synergies, but part of them are above and beyond the synergies. I don't have a specific number to give, but just to give some color on some of the examples. As I went through in my speech, we're closing or mothballing 3 kiln lines in Brazil that we're going. we're able to do that because we have the combined networks and industrial platform of the two organizations. We wouldn't do that if the market wasn't as difficult as it is right now. So it's somewhere between, but what we're doing is we're aggressively going after costs. In Russia, for instance, which is another very difficult market, we've mothballed a plant just outside of Moscow called Voskresent, and we're going to serve the remaining market with the two other plants that are serving that area, one from legacy Lafarge, one from legacy Holcim. So we're able to use, in these difficult markets, it's one of the great strengths and one of the great assets that I have at my disposal right now, is the fact that I have many more degrees of freedom to address my costs than I would have had just as one company or the other company. It's the same thing in China, where we're closing 6 plants right now, and which is something that an activity that's been going on in October, November, December, and all those different cost reductions make me look at countries like China, for instance, which as you see, we see another difficult year in China, 4 to 6% down. I expect, and our business plans show, despite that, to have positive earnings growth in China. I expect to have better earnings in Brazil. This collection of difficult countries, which significantly contributed to a decline for us, as Ron said, I expect to generate incremental year-on-year earnings improvement because of these restructuring efforts. But it's a little different. I don't have an incremental above and beyond synergy number to give to you. Sorry about that. And Ron, maybe I want to ask you to talk about FX.
Yeah, this is a question of how Forex impacted the operating results. So for the full year, it was 2 billion on the top line, 2 billion, and 380 million on the adjusted operating EBITDA. And for Q4, in net sales, it was 600 million, and it was in the adjusted operating EBITDA, 112 million. You can also refer back to the bridge for more underpinning on that.
Does that answer the question?
And the question on FX was also based on the spot levels, whether you can give us a guidance for 2016 on currencies.
2016, we've seen the emerging market currencies somewhat stabilizing, but I'm not going to sit here and do a currency forecast because it's very difficult to do. What you will have to reckon with is that in the first half, of course, the real result compare is a little more difficult because last year currencies were stronger in emerging markets, so there will be some headwind in the first half. For the second half, that will taper off.
Yeah, I think the other thing on currency that one wouldn't expect to repeat is a strong revaluation of the Swiss franc, which certainly had a big impact on our consolidated results in 2015, which is something that happened in January of 2015. Okay, maybe the next question from the webcast.
Next question from the phone comes from Mr. Gregor Kuglitsch from UBS. Please go ahead.
Good morning. I've got 2 questions, please. One is on pricing. Could you just confirm, I calculate Q4 pricing was down 4% year on year if I look at the whole of the portfolio. A, can you confirm that's correct? And B, can you give us sort of the sequential move, Q4 versus Q3? I think you've historically given us that. And in the light of that, that's my second question. Can you maybe elaborate on your comments regarding, I think your introduction said solid profit growth for 2016, what you actually mean by that? And I'm particularly, I guess, referring to the tough comparison basis on pricing you, I guess, will enjoy in the first half, particularly, or whether you think that from here you can actually increase pricing sequentially to actually go to a net realized profit growth, because obviously in the fourth quarter you were still trending negative. Thank you.
Yeah, so the year-on-year fourth quarter price, I'll let Ron comment on that. I think he's got, but I'd just like to give a couple of global comments on pricing first. First of all, it is, our pricing in the fourth quarter, as Ron highlighted, was very much focused around 5 key markets, the ones that he pulled out and called out, where you had some strong movement in those markets. The air has come out of pricing in those markets. It's not going to come out a second time in those markets. So even when I look at those markets, I'm optimistic about year-on-year incremental for the full year. Now, the timing of how that price evolution happened, market by market, the evolution in pricing happened differently in those markets. Nigeria, for instance, is one market that was particular where price was much lower in the second half of the year than it was in the first half of the year overall. But the basic trend of our prices in our markets and the actions that we have taken over the last couple of months in several of our key markets give us confidence that we're going to be in a much better position place for pricing in 2016. And maybe Ron, just on the quarter four pricing.
Yeah, you've said it all already mostly, Eric. So it was weaker in China, Indonesia, Malaysia. It was stronger in the Philippines. Yeah, if you look at Asia Pacific. In Europe, we had Central Europe West was down. There was on the back of what we already discussed, the more competitive imports that particularly have hit Switzerland. France pricing was up in Q4 quarter on quarter. Another was Romania and Russia. The price actually stayed the same. If you look at Latin America, it was much up in Argentina, but it's also partly driven by inflation, as we know. In Brazil, it was down unexpectedly, and for the rest, it was up in Colombia, Ecuador, and Mexico particularly. And we're going to do more there. Middle East and Africa, it was up in Algeria, and then, as we earlier indicated, in Egypt, through the overcapacity, it was down. Nigeria was down, and also Iraq and Zambia, for example. And North America, we've had good price increases in the U.S., particularly on the cement side, while Eastern and Western Canada stayed more or less the same. And as we earlier already discussed on the earlier question, pricing in India was particularly weak in the fourth quarter. Is that an answer to the question?
Sorry, can you maybe quantify in percentage terms Q4 versus Q4 and Q4 versus Q3? Do you have that data?
Yeah, so the overall impact for Q4 was 150 million, 154 million actually, of which 5 countries, and it's also in the bridge that you can see, were accountable for 115 million after 154. Okay. So maybe I can take you in the presentation material that you all have in front of you to the bridge, where it's actually nicely outlined. I'm on page 16. So that is for Q4 year on year. I don't have the quantification for Q3. We can get back to you if that's really what's needed. But I given you earlier the directional impact in Q4.
Okay. And then can I follow up on the EBITDA guidance? Are you actually saying that you're going to be up materially year on year? Is that what you're saying?
I'm sorry, could you repeat the question?
Full year EBITDA, 16 versus 15.
Oh, yeah. Yeah. So I wanted to give your second question. So what are we saying today? What we're saying is we reconfirm our 2018 targets that we communicated to you on December 1st. We're 3 months later now. We've got our business plans in place and our budgets, and we reconfirm those 2018 targets. And when we look at it, we see that we're going to take a solid step, and we're on our 3-year plan basically to get there. When we get that, and we're not going to be giving year-to-year guidance. So we're not giving a specific target, but what I can tell you is that I'm on track, and I'm on track to deliver on those 2018 targets, and I'm confident on that. And when we look at 2016, we'll see that that's a year of solid progress towards those targets, without giving a specific quantification on it, because we're not going to give the yearly guidance.
Fair enough. Thank you very much.
Thank you.
Next question from the phone comes from Robert Muir, Berenberg Bank. Please go ahead.
Thanks very much. Yeah, I've got 2 questions. One of them probably better for Ron, and the other maybe for Eric. Just on the first question, relating to the impairment review that you've conducted, could you confirm that that's over, or is it still ongoing? And then I wanted to focus on some of the countries, particularly Egypt and Canada. At Lafarge Egypt, I think there was about 1.2 billion of goodwill carried there, and it was one of the top 3 sort of goodwill carriers in the group. If I'm reading your new sort of CGU schedule correctly, it doesn't look like Egypt has any material goodwill anymore. Does that relate to a fundamental change in your view of the potential for this market in the longer term? And if that is the case, what has changed? And then in Canada, if I'm right, non-current operating assets are now about 4.1 billion, up from about 1 billion at Lafarge. Can I just know the rationale for that? Can you outline the potential that you see in that market, especially given your earlier comments? And then a second question is sort of more high level. I just wanted to go back to your reduced CapEx plans. There are a number of areas, I think, where competition has established itself or is in the process of establishing itself. It looks like some of the players are able to install integrated capacity at relatively low cost, but also get solid operating performance. How do you plan to compete with that without making investments in sort of better equipment, or is that maybe the sort of criteria that marks an asset out for potential divestment? Thanks.
Okay, great. So, Ron, you want to start with the first question on impairment?
Yeah. So was the question how the goodwill depreciation went from?
Yeah. So maybe Robert, your question is on we had evolutions in goodwill. How does it work? Now, just to remind you, we went through the PPA process, the purchase price allocation, where we took basically at the point of closing of the merger, we reallocated the value of all the assets, and some assets went up, some went down, but that full value at the point of closing was reallocated to all the assets. So to look at the previous values and kind of compare where did it go, how did it was all kind of basically wiped clean in some respect, and the new value was allocated to those assets overall. So maybe that is an explanation of why you kind of are looking, Robert, at kind of how do I see the evolution between the numbers and don't understand it, or can't track it exactly. And then Ron, I don't know if you have anything else to add on the question of impairment.
Yeah, you asked if views on markets had fundamentally changed, if I understood you correctly.
Yeah, I mean, basically,
of course, we have the difficulties in some of the markets that we have mentioned. Mm-hmm. So we looked at that. We did a quite rigorous process, I have to say. The cash generating unit allocation is basically as per the previous year's model, so we have not made significant changes there. So that didn't drive any additional differential in the goodwill write-off that we have seen. Most of the goodwill write-down is in Latin America, expectedly so in Brazil. Then you have in Russia, that's Europe, and then some in Africa and the Middle East, and that's particularly also pertaining to Iraq.
Got it.
So that's how we get to 962 million, I believe.
Yeah.
That was your question. Your typical question or the question that you asked on Canada is already answered by Eric, because that's the PPA step up.
Sure thing. Okay.
Yeah.
And just where did some of that goodwill go then in the Middle East region, for example? If Egypt's not material now, has it been, say, allocated to Nigeria, for example? Do you see better? I'm just trying to get an understanding of where the capital is going to be. Well, you think the potential is. That's all.
Yeah, it wasn't a matter of reallocating from one country to another. Yeah. It was an overall allocation of looking at where the cash flows are generated overall in the group, and then allocating that value to the different assets, and then and that's what it does. So it wasn't going from one country to another. It was reset to zero. The full value is then reallocated proportionately based on the long-term earnings power and potential of the different businesses.
And that process is complete now.
Thank you. Oh, and there's a second question. Sorry, not to cut you off. Coming back to your second question, which was on the idea of there's CapEx investments going on, and our strategy, as I articulated, is to generate 10 billion of free cash flow. So my strategy is not a strategy of market share. I don't think that's the value-creating strategy in our industry. My strategy is one of driving innovation and customer excellence and generating cash flow and returning that cash flow to our shareholders. And that's the game-changing difference that we're committed to, that we're going to do. So, which is a different strategy than a strategy of market share and capacity share expansions. So I will look to grow and develop in markets where I think I can generate and maximize my free cash flow over time. Over the last couple of months, we've completed a very detailed portfolio review. You're seeing some actions that we're already taking that we announced today, and we will continue to take over time. But where I want to play is in attractive markets where we have a strong competitive position and we can win over time. And that's the result of our portfolio review. But I don't feel at all that my strategy is based on market share and the need to invest and develop my capacity share to keep pace. It's based on free cash flow generation and returning value to shareholders.
Got it. That's really clear. Thanks a lot.
So maybe because we're only taking we'll come back to the room here. Yes, sir.
Martin Hüsler, Zürcher Kantonalbank. My two questions are, first, you had merger costs of about 1.1 billion in 2015, and I just wanted to clarify if we should expect further merger costs in this year, or if this year adjusted EBITDA is already more or less the same number as operating EBITDA 2016. And then maybe can you say something about the energy cost per ton in cement production? How did this develop in 2015, and what do you expect as average for 2016?
Okay, so Ron, you want to take the one-off the merger costs?
Yeah. So the 1.1 billion breaks down as implementation costs for the merger, the 500 million. The merger cost itself, so not implementation, but the cost associated with the merger, the fees, the structures, the drivers, 278 million. And the restructuring related to that is 326 million. So what will the amount be for 2016? Well, there's a one-off of about 400 million expected. 350 million of that is merger related, and 50 million is for non-merger related cost. Yeah. Some IT related costs will incur in 2017. There's a little longer time horizon, but that's all included in the 1.1 billion overall guided for. Yeah, so the 1.1 is the merger cost that we overall guided for at Capital Markets Day last year.
Okay, and maybe. Oh, sorry.
No, sorry. I just wanted to know if I answered the question.
Yeah. Is that clear? That first part.
Yeah.
Okay, and maybe a comment, and Ron, you can jump in as well on energy costs, which is an interesting trend that maybe we don't talk enough about in our industry because. Oil price is down. We all see that. It's come back up a little bit recently, but it's affected the whole cost curve in a long, broad range of energy. Coal costs are down. Petcoke costs are down. The key cost components have declined. And in fact, if you look at our overall cost of energy, it came down slightly in 2015, and we would expect that to continue in 2016 as well as a trend. Electricity costs, however, went up slightly in 2016, and we would expect that trend to continue to develop in that direction as well. And gas costs have been relatively flat overall. So our expectation is overall energy, the story for our energy industry and energy would be net a slight decrease going forward. Does that answer your question? Thank you very much for the questions. Another question from the room here? Okay.
Yes, Patrick Appenzeller, LafargeHolcim. I have a question on your deal in Morocco.
Sure.
I don't really understand what's behind. You get 600 million of net debt reduction, so which is very positive. But for that, you have to give away something. Is it a stake reduction finally, or how does that impact?
Well, it's not just net debt. There's cash proceeds coming in. We're not announcing all the specifics of the deal because there's multiple companies involved or different companies involved in this. I think it's a tremendously positive development for us in Morocco. It allows us to create an incredible platform in Morocco and generate a lot of synergies. And we'll work together as well with our partner SNI in developing in Africa as well. So from a overall net debt and our ratio standpoint, it's strongly favorable, and it allows us to optimize and structure our operations in Morocco much more efficiently. Morocco is one of those well-positioned countries that we have, which is strongly and attractively positioned for going forward, and we've had two separate operations in Morocco, and this allows us to bring all those operations together and drive synergies. We announced 45 million of synergies just in Morocco. That's one country. So we're very optimistic about what we're creating here in Morocco.
But it sounds a bit like magic. I mean, finally, it leads to a net debt reduction of 600 million, so it gets cash of 600 million, and then on top of that, it also gets EBITDA. So it's, if you do that with all the companies.
No, maybe to back up and no, there's no magic on. No, maybe it gets into some detail on Morocco. So the two activities in Morocco, we have a 70% owned activity, which is a smaller of the two, and we have a 50/50 activity. So we're basically, in this move, we're taking the 70% owned activity and combining it into the 50/50 JV activity. Now, both of these companies, in the end, are publicly traded activities in Morocco, so we have to be very careful about what we say and very, very respectful about communication in Morocco. But we're going to deconsolidate from a consolidation standpoint the EBITDA associated with the 70% owned, and the overall proceeds and the net debt and effect will be over 600 million, the impact on our overall net debt. What we'll do in future quarters is Morocco is going to become such a big piece of our earnings and our EBITDA on a quarter-on-quarter basis. We will, in some way, Ron and I are still working out how that'll happen, but we'll cull that out specifically for you, so you'll have some visibility on what the operating performance in Morocco is.
So from an accounting point of view, you finally will lose because of deconsolidation some of the EBITDA. Is that correct?
Yeah, I don't look at it as losing, but it'll be deconsolidated. It'll come through the P&L in a different place.
Okay, so that goes to the 600. You get 600 cash.
Yeah.
You lose some of the EBITDA because.
Right. Exactly. To your point on magic, it's not magic.
What is the stake finally, or is that not public?
What is the what?
What will be your stake you own in Morocco after the whole transaction?
Stake is in 50%.
50.
Yeah, 50.
From 70 to 50, now to 50?
Well, it's 70% for one activity and 50% to the other, and that activity is going into the 50/50 JV. Yes?
Catania from Pictet Asset Management. My two questions would be, first, on CapEx. You're guiding for less than 2 billion in 2016. And then at the end of the presentation, if I read carefully, it's 3.5 over the period 16-17.
Yep.
So maybe in simple mathematics, 1.5 or around 1.5 for 17. First question is, aren't you going beyond or below a healthy level of maintenance at this? And the second is related to you highlighted that energy cost will be slightly down for foreseeable future. What about the overall cost? Used to be given a guidance on the overall cost inflation, let's say 2, 3, or 4%. I think logistics cost, how they develop, and personal cost, and overall underlying cost forecast for 16.
Okay. Well, let me take CapEx, and Ron, I'll let you treat the cost inflation question. So CapEx. So maybe to put it all in perspective, and these are all numbers consistent with what we communicated on December 1st. In 2015, on a pro forma combined basis, we spent 2.55 billion of CapEx. So that 2.55 is coming down to under 2 billion in 2016. we had said, in fact, that we're going to spend $3.5 billion over 16 and 17. That's our plan, and our business plan and our midterm plan is built around that right now. So why is that a reasonable amount? If you look at what we're spending in 2016, almost half of the $2 billion relates to large projects that are ongoing. We have a number of expansion projects that we will benefit from as they come on stream in 2016 in Nigeria, in Algeria, in New York State, and we have a number of ongoing projects. Completing those projects is half. So the remaining part of our CapEx in 2016 will be about $1 billion, and we're confident that is adequate for maintaining our assets in good working order. In 2017, we will continue to be able to do small incremental debottlenecking and improvement investments, but we won't be launching in 2016 any new large capacity expansions that would have a big bulk of CapEx in 2017. So when we say $1.5 billion, essentially what we're confirming is there's not going to be any ground broken in 2016 on a big project that's going to consume cash in 2017. And maybe on the question on cost inflation, Ron?
Yeah, inflation was about 2.9% for 2015 full year. For 2016, we expect that to be flat to slightly down due to what Eric just said on the energy prices. Yeah? Oh, a question from the webcast?
Next question from the phone comes from Mike Betts from Jefferies. Please go ahead.
Yes, thank you very much. My question, Eric, and Ron, is just to ask a bit more about this confidence about pricing improving in 2016, and specifically to ask, firstly, some of your competitors said there was a lack of discipline in pricing from LafargeHolcim in the second half of 2015. Would you accept that? Related to that, Ron briefly touched on this performance management system. One of the things is pricing. I mean, what's changing there? Are you monitoring pricing now more on a central basis with central control? Thank you.
Yeah, why don't thanks, Mike, for the questions on pricing, because pricing is an important lever of driving improvement, I believe, in 2016. On your question whether our strategy was around volume in 2015, I would say no. Our strategy wasn't based on volume in 2015. If you look at the countries called out on the list, on Ron's list, you've got unique market situations in those countries. The situations going on in Dangote, in Nigeria with the major competitor in Nigeria, and the situations in several of our other countries listed in that list. Those are unique market situations, and our strategy was not at all a strategy of volume in 2016, and it remains not the case in 2016 as well. I believe we are focused on value for our products, and we've taken a number of actions over the last 3 months in some of our key markets that will bear fruit in 2016. This is something that I personally am following on a regular basis. We've identified our top key markets, and it's something on a regular basis I'm following personally.
On how we're going to performance manage it, you're absolutely right. We're going to do this also much more from a central perspective, from a group perspective. So we built the infrastructure in the management information, so we can have the data, need a little bit more refinement here and there. But I think the bigger thing here is that the performance management will drive strong interactions around managing what goes on, around value creation, and pricing is, of course, one of the bigger factors. We want to understand it. We want to have transparency around it. We want to see that the roadmap go forward is executed quite firmly. So the answer to that is yes.
Okay, and if I could just follow up on that, the number of actions you're talking about, Eric, I mean, are these just price increase in specific markets? I guess what I'm trying to work out is what's changed.
Well, this is something that we're, as you know, Mike, I can't talk about specific markets and specific actions that were taken in specific markets. What I am saying to you is I'm confirming to you that in a number of markets we see things moving much more attractively than they were in 2015 based on actions we have taken. And you will be able to see that play out in 2016. I believe that 2016, one of my messages that I said in my speech, and I believe that the overall environment in 2016 will be more favorable, and our actions that we are driving will drive real progress for us in 2016.
Understood. Thank you very much.
Thanks, Mike. Another one from the webcast?
Next question from the phone comes from Mr. Robert Gardiner from Davy. Please go ahead.
Good morning, gentlemen. Thanks. Yeah, just two from me. Could you give us, if possible, for 2016, so you've already indicated there you're divesting assets in Korea, you're deconsolidating Morocco. Can you give us some indication of scope impacts on your EBITDA, so how much you think is coming out? And connected to that, likewise, scope impacts in terms of positive, in terms of capacity you're bringing online, so the likes of Algeria. And likewise then, in terms of the underlying margin, so you're in the quarter, your like-for-like sales are improving, your volumes are improving, obviously price. The margins are declining very heavily. So can you give us some indication of what markets where you've had very significant cost increases that have pressured that margin performance?
Yeah, and I didn't hear the second part of your first question on, you said Algeria, I think, and then the phone, I didn't, what was the
Sorry, I was just looking for the impact of scope on EBITDA. So the impact in terms of EBITDA divested and then EBITDA positives that you have from bringing online new capacity.
Well, we haven't given a number on the EBITDA impact from the new capacity. We gave specific numbers in December on the amount of new capacity coming on stream in 2016, but we haven't given a number on that. But for the most part, that capacity is coming on stream in Algeria and in Nigeria and places where it'll be sold right away in relatively attractive conditions and situations. So I don't have a number for you on the incremental capacity. We can think about that and maybe come back on that in a future communication. On scope, in the specific countries that we're divesting, there's three different situations. So you have in South Korea, you have approximately a little over 50 million of EBITDA that would be deconsolidated. You have in Saudi Arabia, it's a country that's already deconsolidated in our operations. And in Morocco, the piece that is to be deconsolidated would be approximately 140 million in Morocco. Okay, Robert?
Yes.
And then margins, I guess your question on margins is to try to understand a little bit better on the evolution, specifically on costs. A big piece of the margin decline was driven by price declines in some of those difficult markets that Ron outlined before. There was also a handful of one-off costs that we experienced in 2015 and some one-off benefits that were in the numbers in the fourth quarter of 2014. So on the surface, when you look at the overall cost numbers year on year, we didn't break those out and say they're one-off, but there was more than normal one-off benefits and there was one-off costs built into the numbers in 2015 that doesn't represent the underlying inflation in our cost structure going forward. So we look at that margin evolution, we look at it as a unique comparative in this year of bringing these two companies together between December 2015 or Q4 2015 and the pro forma numbers in 2014.
Okay, very helpful.
I don't know if you wanted to add anything to that, Ron?
Oh, I'm good. I think overall, if you look at how the cost came together, 127 million. Within that, what I said on inflation, and then you, of course, correct a bit for the energy, we can say that we are bringing our costs down on an underlying basis. So we're taking decisive actions on cost.
Okay. Great. We'll take one last question, and then we'll close it. So we'll take it from the webcast.
Next question comes from Alejandra Pereda, Morgan Stanley. Please go ahead.
Hi, yes, good morning. I have two questions. The first one is a margin question specifically on Europe. If I look at the pro forma data you gave us for the quarters in 14 and 15, the trend in volumes and prices in the second half is not very different to the trend you reported in the first half. But the margins have started falling down very aggressively. It's like 350 basis points in Q3, more than 400 basis points in Q4. So I was wondering if you could build up exactly what is bringing this trend and if we should extrapolate it to the first half of next year. And specifically on Germany, you are providing today a minus 16% factor in pricing. It was minus 9 in 9 months. Feels weird.
Alexandra, I'm sorry to cut you off. Somehow we have a terrible connection, so I don't think it's just my hearing.
Can you hear me better now?
I'm having a hard time hearing the question. I don't know if there's a way to either pick up the phone or the connection we have with you is very, very difficult.
Can you hear me better now?
Yes, there we go.
Okay, sorry.
Much better.
The question was...
Could you re-ask the question? Sorry, I missed it.
Sorry, after the longer speech. Sorry. No, it was regarding the margins in Europe. If we look at the pro forma data you provided for 14 and 15, the volume trend and pricing trend in Europe in H2 is not very different to H1, but the margins have fallen sharply in the period, Q4 even worse than Q3. So I was wondering what's behind that and if we need to extrapolate it to the first half of next year. And specifically on Germany, you provide a minus 16% pricing component for full year. It was minus 9 in 9 months. I mean, it feels like a weird performance there. And the second question, much shorter. On the India disposal, do you have any timing that you can give to us? Have you already received all the offers? Are you still hearing offers? Do you have any guidance there?
Sure. I understand the question much better this time.
Sorry.
On Europe and margins, and specifically on Germany. Now, don't forget there's a scope difference in Germany, and there was a lot of deals that happened in 2015, and one that's also easy to forget. There was an exchange of assets between us and Cemex that happened involving the Germany assets in 2000 and closed at the beginning of 2015, which has created some mix in the German market. It's not reflective of what's going on in the underlying German market. If you just come back to your question as to margin decline, the bulk of the margin decline in Europe is driven, it's better to think about it by country, and it was driven by 4 key countries: Switzerland, France, Russia, and Azerbaijan. And you see some of the effects of oil hitting there, and the timing of oil hitting demand. And the second half of the year in Switzerland was more difficult overall. There was import pressure in Switzerland, and it affected our margins in Switzerland. Now, we put in place action plans. We think going forward we're going to be in a better position. But it was more a bigger issue in the second half of the year than it was in the first half of the year. So thank you very much.
Just so sorry on India, on the disposal. Do you have any guidance?
Sorry about that, Alexandra. On India, well, we have our process well in place. We have a large number of people who have expressed interest. India is one of the hot markets, right? For the reasons I said earlier, low oil price and demand. We're expecting demand to be up 4 to 6% this year. So we're seeing a lot of interest, both from strategic and non-strategic buyers. and we're fully on track, and we're very optimistic of being able to both get good value and do it in a speedy way. So we'll probably have more to announce on that, I would say, around the middle of the year.
Okay. Thank you very much.
Thank you. And I would just like to say a big thank you for all your questions and your interest, both everyone here in the room and everyone who's joined us on the webcast. So thank you very much, and we'll look forward to talking to you in May with our first quarter results. Thank you very much.
Ladies and gentlemen, the conference is now over. Thank you for choosing Chorus Call, and thank you for participating in a conference. You may now disconnect your lines. Goodbye.